What are the themes so far for 2026?
2026 is continuing as it began with GDP weakening, and the labor market also weak. GDP for quarter one came in at GDP growth at 1.6%. That's much weaker than what we saw last year at this time, and the labor market's not strong. The labor market, especially for manufacturing, looking weak as well. The reserve will make no rate changes, not hiring, but not many layoffs either. Small firms are not doing as well as the large firms. And we're seeing some interesting related to the war with Iran, that we're seeing front running of purchases. That is, to get ahead of any supply chain disruptions. The supply managers that we survey are buying in advance to get ahead of price increases, but also to make sure to avoid any supply chain disruptions. I'd call it an economy that's still not doing as well as we'd like to see, and certainly our survey backs that up.
According to supply managers in the 9 Mid-America states, how is the economy performing?
The May number was at 54.4. Of course, the index moves between 0 and 100, with 50 being above growth neutral. So 54.4, I'll call that okay. Like to see it a little bit better, and that's down from April's 56.0. The trade number is still not looking good. The import values moving slightly below growth neutral, 45.9, and that's up slightly from April's 44.6. Export reading 47.4, and that's down from 49.9. So trade numbers not as good as we'd like to see. Almost 3 out of 4 of the supply managers expect no supply chain disruptions from the Iran war, and 1 out of 4 are front running purchases. As I said earlier, by front running, I mean they're buying in advance of price hikes, they're buying in advance of any supply chain disruptions. And for 81% of the supply managers indicated that the war with Iran had pushed input prices higher. So that's certainly not what we'd like to see. We're seeing excessive pressure on prices, and that's more than what the economy can stand without any interest rate increases. Here I'll bring up the chart of over the last 18 months, and in blue there you'll see the Mid-American index, and as indicated earlier, it's at 54.4. Later on this morning, we'll hear and see the national PMI, Purchasing Management Index. Is it now? Last month it was at 52.7. I expect the number to be up slightly from May when it's reported later on this morning. And there in black there is the overall Creighton survey of bank CEOs and rural areas of 10 states. That's principally the farm economy, and the farm economy is not doing well. It's well below growth neutral at 45.7 in May. So all in all, not a good month for this part of the country, but it could have been worse. Again, the overall index is above growth neutral, and it's above what the national number has been doing as well.
What were the hiring trends?
Hiring was not good in May. Hiring was at 47.0, and that's below growth neutral, of course. And that's down from April's 50.2. That's after 2 straight months of above growth neutral readings. So overall, the layoffs, we're just not seeing a lot of layoffs, but we're not seeing a lot of hiring. 1 out of 15 of the firms reported layoffs, while 3 of 4 firms reported normal hiring. So that's what we're seeing. Just not a lot of strength in the manufacturing sector. If you look at U.S. manufacturing, over the last 12 months is down by 70 to 80,000 jobs. That's a negative 0.6%. If you look at regional manufacturing, it's down by about 17,000 jobs, and that's down by 1.2%. So the hiring and not as strong as we'd like to see for the Mid-American economy.
What inflation trends are you noticing?
Inflation is much like what we're seeing at the national level. This is a wholesale inflation gauge, up to 81.7. That's well above growth neutral, and that's up from April's 75.6. That's obviously not a good reading, and that's coming from 2 sources right now. The 2 sources are the conflict, the war with Iran, but also we're seeing it from trade, international trade, trade restrictions, tariffs. Tariffs are pushing up prices as well, and also certainly supply chain disruptions having some impacts on inflationary pressures. The delivery speed, that number is up to 63.9 from 63.1. Now that's the highest since January of 2024. What that indicates is just more and more supply chain disruptions, supply chain bottlenecks, and we're seeing that across the board in manufacturing. U.S. inflation remains well above our inflation rate, and the CPI, the Consumer Price Index, remains well above the Federal Reserve's growth 2% target. The Federal Reserve's major target, the PCE, is expanding at 3.8% year over year. That's well above, again, the Federal Reserve's target of 2%.
What is the economic outlook?
The outlook is we're not going to see any rate changes. There are some producers hoping for a rate change. Well, that's just a rate change meaning a rate reduction. That's just not going to happen. Only a 10% probability of a rate cut when the Federal Reserve meets on the 16th and 17th of June. The new Federal Reserve head, that will be Warsh. Warsh will pursue policies much like Powell during his early period. But on balance, we're going to see a tougher stance toward Federal Reserve balance sheets. That means growing the money supply effectively. We're going to see the money supply growing more slowly in the second half of 2026. Of course, that's good on the inflation front, but it's not good on the overall GDP, overall growth, which I expect to continue to slow in the weeks and months ahead. The Fed is really caught between a rock and a hard place, meaning that inflation is too high for a rate cut, but the economy is certainly too slow, too much layoffs, not enough hiring to increase rates, to increase the interest rate. So we're not going to see a rate cut, but we're not going to see a rate increase either in June this month. Keep an eye on the Federal Reserve's balance sheet as it moves sideways. It's still growing. It's still growing. The balance sheet's still growing. What I mean by that is the Federal Reserve continues to buy $1.1 billion per day of U.S. Treasury bonds. That's just too much out there, too much incentive, too much push in terms of inflationary pressures. We're going to continue to see that. But again, I expect the Federal Reserve Chairman Warsh to move back on that and cut back on the Federal Reserve's buying of U.S. Treasury bonds. Inflation is going to continue to move month over month, quarter two and quarter three, well above the Federal Reserve's target. And again, that's got to do something to quell the inflationary pressures that we're seeing, which is going to mean, again, the balance sheet, we're not going to see as much buying of U.S. Treasury bonds. We're not going to see any rate cut, at least coming from the Federal Reserve. Long-term interest rates will continue to move higher because of this inflationary pressures. So keep an eye on the bond market. We're going to see higher mortgage rates. Mortgage rates are up to the highest level in several years, and of course that's not good for the housing market. But keep an eye on the bond market, as I said. The yield on the 10-year Treasury, if it should move above 4.9%, that would be a significant problem. It is moving in that direction, but right now we're seeing the U.S. Treasury bond yield at 4.4%, around that. That's in the range, which is not really any significant concern right now. But again, the movements upward would be a real problem. And keep an eye on that. Federal Reserve balance sheet, as I said earlier, we're talking about $35 billion over a 4-week period. That's got to move lower. The Warsh is going to move to cut the growth in the balance sheet, and perhaps even later on in 2027, we could even see the Federal Reserve's balance sheet being reduced by Warsh and the Open Market Committee, the rate setting committee of the Federal Reserve. The national ISM reading for May later on out this morning, I expect that number to be up slightly, but still in what I'll call an okay range, much like our Mid-American output number, we're talking about a number that's just okay, between 50 and 55, and that's an okay range. Above 55, I'll call that in the expansionary mode. We're not there yet. Obviously keep an eye on the price of a barrel of oil. Barrel of oil, if you look at backwardation, that's looking at the future prices versus today's prices. They are moving lower. Now, what that means is that the market is looking for a settlement in Iran, and of course that settlement will be accompanied by lower oil prices, moving down from 190 to $100 a barrel to something like 70 to 80, and then maybe even lower to 60 to $70 a barrel. Listen carefully to what the voting members of the FOMC, that's the 12 members, that's the 7 governors plus 5 presidents, what they have to say about the interest rates and inflation and the labor market, of course. And the junk bond yield, it's still too low in my judgment. Those yields should be higher, reflecting the increasing risk that we're currently seeing. And of course, watch next Friday's, or I should say Friday the 5th, June the 5th, jobs market, and then the ADP release of private jobs. So it's will come out this Wednesday, and seeing what happens there. Anything above 100,000 will be good news. Anything below 100,000 will not be such good news. Anything below 50,000 would be real concern. And what's the price of gold? Although the price of gold is really moving sideways to a bit down. Same with silver, still not there. That's because the dollar has increased in value. If we see the dollar moving down in value, that would put upward pressure on gold prices and silver prices. Just not there right now. And of course, the overall economy is not doing what we'd like to see, but it's doing better than what it could be doing. And of course, the president has turned to the stock market, saying, "Well, look at the stock market." Well, the stock market is not the economy. The stock market is being driven higher by the what I'll call the blind robot. That's passive investing. That's individuals in their 401ks buying ETFs, exchange trade funds, and that's pushing up the stock market, even as the economy cools, even as the labor market cools. And that's our summary of our survey for the month of May here on the first business day of June. Until we meet again next first business day of July, may your economic cup runneth over. This is Ernie Goss from Creighton University signing off.